Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
So wait, what is up with the ECB? The global bond market losing some steam after notching its longest winning run this year after the European Central Bank raised its inflation forecasts after delivering a widely expected rate cut. It made us be like, wait, what?
Okay, it was a historic move. It saw the ECB slashing borrowing costs ahead of the Fed meeting next week. Officials led by President Christine Lagarde said that while the inflation outlook has improved, quote, markedly, they'll keep policy rates sufficiently restrictive for as long as necessary.
All right, with what you need to know, why you should care, back in studio with us is Bloomberg International Economics and Policy Correspondent Michael McKee. Mike, so widely expected, but it seemed like, why do you cut rates when you think inflation is going up?
Well, a couple of things. One, they think that the inflation path is becoming more clear, that they can make these revised forecasts with more confidence that that's actually going to happen, that over the long run, inflation will come down to target. And the other thing they point out is that the real rate as inflation comes down goes up. So the argument today from the ECB management was that they are basically just keeping policy as tight as it was because inflation's come down a lot, and even though they cut rates, the restraint on the economy has gone up because real rates are higher.
Okay.
Does that make sense to you?
Well, it makes sense to me. This is a debate that Paul Krugman is wading into it in the New York Times today, saying the Fed's behind the curve because the ECB did the right thing. You're going to have people on both sides arguing, and kind of the bottom line is 25 basis points isn't going to make a difference one way or another. It's a bit more about the psychology of the markets and how they take it and what's going to happen in the future. The ECB today, Christine Lagarde, was very cagey about that, which is why everybody's calling it a hawkish cut, because they didn't make any promises, and they did, as you said, talk about keeping rates high for longer. The Fed, on the other hand, is probably not going to do anything, but they will come out with a new dot plot, and that will set the direction for the markets in the U.S.
Okay, well, speaking of that, this is ahead of the U.S. jobs report tomorrow, the CPI report next Wednesday in the U.S., the same day that the Fed finishes up its meeting and gives its update on economic and rate projections, which you just referred to. Does what we saw from the ECB today mean anything to Fed officials?
No, both of the ECB and the Fed have the advantage of being the central banks for huge economies. So they really are able to focus on their own economies and do what they need to do for them. If you're in a small country, you're going to be affected by either one or both because they're big trading partners. They're going to be affecting the value of your currency. But in this case, it doesn't really have an impact. The Fed and the ECB will do what they have to do for their own economies.
All right, so now we want to get into a little bit more when it comes to payroll, because we obviously have the monthly read tomorrow at 8:30 a.m. Wall Street time. Mike's going to stay with us. We want to bring into the conversation Bloomberg News economics reporter Rich Miller. He is in our Washington, D.C. bureau. Rich, you've got a great story that's out on the Bloomberg, and it gets into why U.S. payroll gains may not be as robust as reported. What gives, and what is the data that points this out?
Bear with me a second. It's a little complicated, but
we like complicated.
Good. There's something called the quarterly census on employment and wages. It's basically a compilation of that the Labor Department has of unemployment insurance tax records filed by businesses. This covers like more than 12 million businesses, as opposed to the monthly payrolls report, which is a survey of about 119, 120,000. So this quarterly report, which is commonly called among the geeks as QCEW, suggests that the monthly payrolls report last year was overstated by about 60,000 per month. That means, the labor market may not be quite as sturdy as Jay Powell thinks, as Joe Biden hopes, and that kind of raises the stakes for the Fed as it tries to sort of balance cooling off the labor market, but not killing it.
Rich, the QCEW, you note in your piece that the data are eventually used in annual revisions to the monthly data.
Right.
Does the dispersion that we saw with the data released earlier today match dispersions that we've seen in other quarters and other years when it comes to the data?
Traditionally, if this holds, and the QCEW data is also occasionally revised. So, but if this difference holds, it would be one of the biggest revisions in the payrolls data that we've seen. For example, last year there was a lot of concern about a big downward revision in payrolls for the previous year. As it turned out, the revision wasn't all that big. It came in at less than 20,000. So it's still early. The department will give sort of an early estimate of what it thinks the revision will be in August. So we're still a number of months away from that. And that's when we'll get a sort of final tally about how much the numbers were off.
I want to bring Mike in because no diss to the QCEW, and I like wonky and I like nerding out here on economic data points. But Mike, we've had a lot of conversations with you. I feel like this doesn't come up. Why is it coming up?
Because the data just came out yesterday. Some preliminary data was released in May. And
so it's new data sets?
Basically what they do is they release a report every quarter for the previous quarter. So, actually for a quarter and a half back, because the May data and the data we got today incorporated the final quarter of 2023 and then the first quarter of this year.
Okay.
And we have not had such a huge, as Rich was saying, such a possible huge change. But as you noted, last year, there was some of this worry going around in the economics community, and it didn't really prove out. And by August, it is possible the current QCEW numbers could get revised lower as well. But what we get in August is one giant number. So this is the whole amount for the year through March, and then they have to divide it up, which we won't get till next February, month by month. So you could see some of these months where we got 300,000 jobs, you get 240,000, that's going to not look too bad. But if you had something like 100,000 jobs and you lose 60,000.
You would say, Fed, you're behind the curve, perhaps?
Or they could say that particular month you lost every job and it was negative. And that's Bloomberg Economics is saying that's a possibility, and they're all worried about that.
So we're in a blackout period ahead of the Federal Reserve meeting next week,
because I've been counting you down for the last month.
Hey, and we're finally there, Carol. We're finally there.
Sorry.
But Mike, you talk to Fed officials all the time. This is data. How do you think they're taking this into account ahead of the policy meeting?
Well, I'm sure they are, and I'm sure they've done the math and tried to figure out for themselves exactly what it might mean. But as we said earlier this week, the Fed has to deal with the numbers that it has at the time it has them to make their decisions. This could be another input. But, is it going to come through, in which case maybe you wanted to cut rates, or is it not, in which case you're maybe moving too soon? Because this is just an if at this point.
Rich, how do you kind of think about it against what the Fed might do? And also kind of, I feel like there was a story on the Bloomberg terminal today from our Bloomberg economics team, just about kind of the continuation of like seeing softer and softer economic points, whether it's on the consumer, on the labor. Like we are starting to see some softness, not necessarily everything falling apart. But so how are you thinking about this new survey, the QCEW, against kind of the broader backdrop of what we are seeing, anecdotally or actual?
It just adds to the confusion, right? Basically, we've got all these conflicting signals. The trouble is they're trying to cool things off, but they don't want to cool them off too much. So the thing, you're constantly asking your question: are things slowing? First, yes, they're slowing, but are they slowing too much? We're worried. So and this just puts one nugget or one sand on the side of we're slowing too much, but there are other sands on the side of this looks like a soft landing. I think it just makes it much more difficult, and unfortunately raises the risk that the Fed can make a mistake, either that it's, it cuts too soon or cuts too late. It just makes their job, which is already darn difficult, even more difficult.
What I want to ask Mike, and come on back in, it's like, why couldn't the Fed, maybe things are slowing down faster, do 50 basis points versus a quarter? Is it such a shock to the system? Like, if they feel like they're getting behind, what's the difference of doing something like that versus like a quarter of a point gradually and really forecasting the heck out of it?
If they did feel that the economy was falling off a cliff, they would probably go 50. Not inconceivable they could go more.
And they wouldn't have to wait to a meeting to do it.
They went 50 and 75 in 2000 when the tech bubble burst. But they wouldn't surprise with that, because then the problem becomes for the markets, what do they know that we don't know? I mean, how bad really is it?
Right.
And obviously during COVID, it was really bad, which was why they went to 75 basis points. But there were millions of people dying, and I mean, it was very obvious to everyone that the Fed could do that, and they sort of telegraphed that they would. So they could do 50, and that's one of the arguments they make for holding, is it's easier to cut rates and stimulate the economy. And we know how to do that. So if we're behind, we can catch up. Now, you can argue about that, but that's their argument, their feeling.
Hey, Rich, I just want to wrap up with the idea of something that you flick at the end of your piece, of undocumented migrants and the way that they could be or not be accounted for in this data. What did you find with the sources you spoke with when you were reporting this out?
Well, I mean, this is all pretty confusing, but some people argue that the QCEW data, because it's companies reporting effectively to the IRS on their unemployment insurance taxes, that they might not want to, if they have undocumented workers on their payroll, they might not want to say anything about that, and they would anyway. They wouldn't be covered by the unemployment insurance system. So therefore, that the argument is that unlike in past years when we didn't have a big surge in immigrants, these QCEW data are basically understating what the true level is. But that that's open to debate, and it's yet another thing that the Fed is wrestling with.
Yeah, talk about wrestling, right? It's like kind of conflicting. Rich, thank you so much. Really appreciate your reporting. Rich Miller, economics reporter at Bloomberg News, joining us there in our Washington, D.C. bureau. You bet. Rich, thank you. Mike McKee, thank you so much.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
New Yorkers, we like to debate a lot of things, and count congestion pricing is one of those topics. It can get kind of heated when you bring up the topic. Some are definitely cheering New York Governor Kathy Hochul's last-minute decision, this was yesterday, to indefinitely halt a congestion pricing plan. Others remind us of the possible consequences of that move. I have to say, when it crossed, I thought this was kind of a done thing. I was kind of shocked reading my phone.
I think shocked is a good way to describe it, and I think a way a lot of people felt, including perhaps our next guest. Simply put, New Yorkers may be headed for the summer of hell. The story on this among our most read today on the Bloomberg Terminal. Here with more, Bloomberg News New York politics reporter Laura Nahmias, along with Michelle Kaske, who's a reporter too here at Bloomberg. Both are joining us on this Thursday afternoon. Okay, so Laura, I just want to start with you and remind everybody how we got to this place, and also give us your reaction to seeing this news yesterday morning.
I think it's fair to say that everyone in New York and even further beyond was totally shocked by the governor's decision. Everyone I spoke to yesterday, people in politics, well-known transit advocates, said they got no heads up about it. They were totally surprised. And this came about, it's been many years in the making. I mean, the idea was first proposed decades ago, but it was passed by the legislature and signed by former Governor Cuomo in 2019. And then there have been a series of things that have delayed it, environmental assessments, various federal approvals that needed to be passed and signed, and it was scheduled to start on June 30th.
I mean, the tolling gantries, right, are in place
They
on
are
the streets
in
of New York
place.
City.
It
The
costs a lot of
signs
money
are in
to
place.
put that up.
Right.
Yes. Truly stunning. People at the MTA were stunned. Hard to find anybody who knew this was going to happen before she officially made the announcement.
Michelle Kaske, we want to bring you. You're a reporter, too, here at Bloomberg. You've been out on the streets, and it sounds like you've been talking to folks about this. What are you hearing?
Well, definitely the surprise is definitely real, and now the issue is what does the MTA do next? And they were counting on $1 billion a year coming in from congestion pricing. So the issue is, how do they pay for their infrastructure now?
Well, before we get there, because it's like I said, New Yorkers love to debate things. There's two sides to this story. Laura, let me go back to you for a moment. I mean, why was she maybe right to pause? I mean, we were talking with our Michael McKee. There are people where this cost will be a problem, an issue in an environment where things are costing a lot more.
Right. So that was the rationale that the governor offered in a short video message that she released yesterday. And recent polling had found that although a majority of New Yorkers supported the measure before it was passed in 2019, in recent weeks and months, a majority of New Yorkers don't like it. I think the numbers were something like 63, maybe 68% disapproved of it.
But a growing number of New Yorkers.
Yeah, but the caveat there is that there's all of this social science research and people familiar with similar polling plans that have been enacted in other cities in other countries all found that the polling was really negative right before something is implemented, because you're about to pay the real cost, but you aren't seeing the benefits yet. So there was a hope among people in the know that people would get used to it and they would start to like it more. Like, an analogy is the smoking ban in New York City was really, people didn't like that before it took effect, and then eventually they grew to love it.
Before we move on to the summer of hell, which we can't wait to talk about, but to be fair, like Tim, you bring this up often, this poll of like stock market doing well, economy still doing well, tight labor market, and yet so many Americans don't feel good about their own economic plight. Michelle, come on back in here before we get into what the MTA has to do. I mean, your thoughts on, for some Americans, this is another additional cost to, a pocketbook or wallet that's already strained.
That's definitely true. As much as, there's millions of people a day who use New York City's transit system, charging most drivers $15 to enter into Midtown Manhattan, that really does add up for some people who have no choice but need to take a car. For whatever reason, they have to take a car, and not just maybe once a week or twice a week, but maybe 5 times a week. There was, I recently, a number of weeks ago, was on the east side, Midtown East side, and I was at a medical facility, and the people there, the nurses and the staff, were talking about how some of them who live deep in New Jersey, they have to drive to get to that location. And, some of them were wondering if they might even need to look at other jobs because that $15 a day, 5 times a week does add up.
Well, Michelle, what about the other costs associated with this? Not the costs that would be the result of congestion pricing, but the cost now on the MTA and to the riders who might be stuck underground on broken subways with signal malfunctions, late to appointments and late to work, the loss of productivity from a crumbling subway here in New York City. What about that cost?
Yeah, it's definitely real. People are already, they're feeling it already. The system is more than 100 years old. And, back in February, even the MTA had to suspend entering into new contracting work because of the uncertainty with the congestion pricing revenue, given all there have been these legal challenges against congestion pricing. And so they couldn't promise work to contractors because they just really couldn't move forward with that yet. And, what that means is they can't already, before Hochul's decision, they were stalling on really necessary work to help modernize the system, to fix it, to repair it, to get it to, the thing about the signal upgrades, that helps the trains, that really decreases delays, helps the trains run faster. that's improved service right there.
I got to say, in the last few
riders won't
months,
be getting
we've
right
all
away.
had those moments. I know we had some tapings, and it's like nobody's here because we just can't get here. We're just kind of stuck. Laura, back to Governor Hochul and, how they make up the shortfall now. If they're not getting, money from congestion pricing, what is the governor proposing that they can do?
She is proposing, and this also astonished people, replacing the revenue from the congestion tolling program with a payroll mobility tax. Our understanding is that it's something similar to a tax that was enacted under former Governor Patterson and then partly repealed in 2010 because it was so unpopular. It actually ended up resulting in or was blamed for the losses of a bunch of Democrats in the state Senate and suburban districts in 2010. And the legislature, although they're discussing this right now, the last day of the legislative session for this year is tomorrow. Very unlikely they get anything passed by tomorrow, or a bill drafted, or even
That's interesting
discussed.
timing.
Yeah, it's politically could be a really heavy lift to enact a totally new tax to cover the shortfall. So we'll see what happens.
We talked about with Mike a little bit, right?
Exactly. Yeah, Michelle, come on in.
Guys, I'm sorry, if I could just piggyback off of Laura there. Yeah, so the businesses in New York City and 7 surrounding counties have been paying this payroll mobility tax for a few years now. Just what's really, really surprising is that last year the state lawmakers actually increased that tax on the largest New York City businesses. And so it's just it's surprising that the legislature is actually has an appetite to at least consider raising this tax again. This is going back to the business community again to help offset the loss of the congestion.
And at a time when, story after story, we see businesses moving out of the city and moving employees to other states. Michelle, real quick, the budget shortfall that the MTA will see this year that it was already relying on, where is that going to come from?
Yeah, definitely. So if state lawmakers, if they really do pass an increase on the payroll mobility tax, that could then offset the loss from the congestion pricing
But if they
revenue. If they don't, and also remember the deficit, the hole now is in MTA's capital plan. So this is their operating budget, which keeps the lights on and pays their workers and all that good stuff. This is the capital budget, which pays for all the infrastructure upgrades, infrastructure needs. Mm-hmm.
Yeah, to kind of make some fixes and stuff. Laura,
yeah, definitely.
Laura, 10 seconds. Is this really ever not going to happen in New York City, or who knows?
We don't know. The governor hasn't said that it's totally over, but she indefinitely delayed it. It is limping along on life support right now. But the blowback that she's receiving from some people in the legislature and advocates, I don't know. We'll see. The next couple of weeks should be critical.
All right, we'll be watching. Laura Nahmias, New York politics reporter here at Bloomberg News in studio. Michelle Kaske, reporter at Bloomberg News, out there on the streets with the latest on congestion pricing.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, Carol, you might recall the story from Bloomberg's Janet Lorin last month about Bob and Ellen Thompson, a couple in their 90s who are donating $121 million to expand a scholarship program at Bowling Green State University in Ohio.
Right? Great.
Yeah,
Sounds
great.
incredible. Absolutely. There are, however, some strings attached to make sure recipients earn degrees. According to the terms, 80% of the students receiving support must graduate within 4 years. Otherwise, the public school team there has to foot the bill for each extra semester of tuition.
We've got with us Rodney Rodgers, the president of Bowling Green State University, joining us from Bowling Green, Ohio, as well as our own Bloomberg News higher education reporter, Janet Lorin, who joins us here in the Bloomberg Interactive Brokers studio. Janet, I do want to start with you. We know the story, we've talked about it, but I do want you to remind everyone about the donation and give us sort of the nitty-gritty of the strings that are attached here.
Well, what I found remarkable about this donation, there were several things. This 90-year-old couple had met at Bowling Green in the 50s, I believe, graduated. Long story short, Bob Thompson entered the business of an uncle, a road paving business, at the time when Dwight Eisenhower decided he needed roads paved in the United States, Interstate Highway
We still
Act.
do, but anyway.
You know what they say? There's gold in the streets.
There really is.
Interstate Highway Act,
Yeah.
and Bob's business was quite successful. And then they sold it in 1999 for over $400 million, and they became noteworthy because they gave about $100 million to their employees, often to help them start retirement funds, which is also amazing. And at the same time, they heard from their alma mater, Bowling Green, that they just hadn't had a relationship with in almost 50 years.
Yeah.
And at a football game, this relationship was rekindled. University of Michigan crushed Bowling Green, but there was a nice relationship that came out of it. And they started donating money. And eventually they decided they wanted to create this scholarship program to help kids finish schools and in 4 years. And,
Right.
and Bob Thompson pressure tested this program. That was a term he used in business just to make sure the school could handle getting this huge influx of money and to make sure that kids could finish. And then over time, he had some great investments. They were actually bond investments, and they had more money. And he met with President Rodgers and wanted to hear about his long-term goals with the school. Would he be sticking around? And they decided they wanted to give more money. It has to be spent within the next 14, I think, years, get these kids through. It won't be an endowment. It has to be spent.
Interesting.
And the school has to match it. And if the kids don't graduate within 4 years, Bowling Green will pay the tuition for each semester for the students who are still sticking around after 4 years.
Well, Rodney Rodgers is with us. So, Rodney, first up, just what this means for the school, the direction of your school, the future of your school.
Well, this gift is certainly transformational to Bowling Green, but more importantly, it's transformational to the over 6,000 students that it's going to serve over this next decade plus years. It allows us to serve so students from modest income families who want to get that college degree, minimize their debt, and be prepared to go out and do some amazing things in our communities. So it means a lot, especially to our students.
So why is it so hard for kids to finish college? There was a statistic like only 62% graduate within 4 years.
The challenge that we have today, as the cost of education has increased because of decline in investment from many states across the nation, and there is an escalating cost. So many students, especially students coming from more modest income families, they work 2-3 jobs. They need to borrow. They worry, as we all do, about the level of debt. And so I think all of those sorts of things kind of get in the way of completing college in a timely way. So that's one reason. This program, which is really a three-way partnership. So as Janet had mentioned, the Thompson Foundation is providing some funding. The university needs to find ways to match that funding. It is not a free college. Bob and Ellen made it clear this isn't free college. We want the students to have some skin in the game. So while the majority of tuition is covered by this scholarship program, there is about 10% that is covered by the student. And the student has to do 20 hours of community service each year to pay it forward. So everybody's got a little bit of skin in the game here. As Janet mentioned, if they don't graduate in 4 years, the university's on the hook to cover the tuition until they do graduate. So we are highly motivated. The student is highly motivated, and we certainly have found this to be very effective, increasing that graduation rate during this pressure testing period to nearly 90% four-year graduation rate.
I love the skin in the game. I think it's really smart.
So the students also get a coach to work with them as part of the requirements. And how does coaching help these students finish within 4 years, perhaps finding jobs or internships or making sure they get the right classes so they can finish in 4 years?
Yeah, an initiative we started here at the university called Life Design, and it's an initiative that's really available to all the students, but the Thompson Scholars absolutely must take advantage of it because it's part of the requirement. What it does is, using design thinking principles, we help students navigate. We empower the student to navigate this collegiate experience as they transition here. Many of our students here at Bowling Green are still first-gen students. 35% of our student body is first-generation students. And those students especially sometimes need a little bit extra support on how to navigate. But what we do is give them the toolbox to navigate it using design thinking principles. And a big part of that is prototyping, beginning to think about the kind of life you want to lead, the kind of career you want to lead or to be involved in, and how do you prototype those experiences, which is all about internships and co-ops. Right. And so it feeds nicely into the transition from college to life as well.
President Rodgers, what's the typical 4-year graduation rate at the school right now? How long does it typically take students to graduate?
So our 4-year graduation rate is closer to 50%.
So that's going to be some serious work to ensure that these students do graduate in 4 years.
Yes.
What are you budgeting in terms of students not being able to do that?
Well, from a total dollar amount, we assume there's probably 5% of this group of students that we may need to have some extra skin in the game. But I'll tell you, Tim, what we've learned, honestly, the pressure testing of this, and this is why we are willing to be held accountable for this type of philanthropy. And that's what I think is a key story here. This is very much about accountable philanthropy. And why we are willing to be accountable is, during the pressure test, we found that we can act, if we help take away the financial challenge the student has, they want to graduate in 4 years or less because they want to begin their career.
I do have a question, though, and I'm wondering in terms of, is this going to change like the admissions process of who you accept because of the importance of making sure these kids get through in 4 years?
Well, we are a selective admission university to begin with. So we we're admitting students who we believe can be successful at the university. So they have hit an appropriate kind of academic admission standard where we believe they can be successful here. This program basically takes away the majority of the financial need, though. And by taking that away, students can focus on their collegiate experience.
And how does it help in terms of figuring out what you want to do, what is the class path, what courses to take, so you're not wasting time in your major?
And President Rodgers, we only have about 30 seconds left.
Real quick, the Life Design Initiative, from the first time they step on campus, they meet with a design coach. They lay out what we call the Falcon flight plan, which is basically, we're the Falcons, that's our mascot. The flight plan really takes them through that 4 years, and they learn how to navigate that from day one. To be thinking about what's the prize at the end.
We're looking forward to checking back with you and Janet on this as these students progress. Rodney Rodgers, he's the president of Bowling Green State University, along with Bloomberg News higher education reporter Janet Lorin. Our thanks to both of you.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just about 18 minutes left in today's trading session. It's kind of an interesting day, I feel like. We're getting ready for the monthly jobs report tomorrow. So the economy, U.S. economy, is certainly front of mind. And this, of course, we've got a Fed meeting next week. So watching what they might say about the future rate environment to come. So I'm curious what our next guest has to say.
Yeah, Martín Escobari is co-president and head of global growth equity at the private equity firm General Atlantic. He joins us here in our Bloomberg Interactive Brokers studio. The firm has approximately $90 billion in assets under management. When people hear General Atlantic, they think private equity. So talk to us about the public equity side of this, the growth equity side of this.
Listen, we've been doing growth equity for 43 years. And what growth equity is late-stage venture capital. It's investing in high-growth companies. Our companies are growing 30, 40, 50% per year. Majority of them are already profitable, and we're helping them scale to the next level. We take them public, and we hold them while they're public. But the 80%, 90% of what we have in the portfolio, and the 90 billion that you talked about, is still private.
Yeah.
And about 10% of what we do is public, because we took them public most often.
How has that activity been in a higher interest rate environment over the last couple of years?
It is the worst of times and the best of times for growth equity today.
Unpack that. Why?
It's the worst of times because the IPO markets have been shut down effectively for 2 years.
Right.
That hasn't happened since 2000.
Some say it's not going to necessarily come back to the levels that we've seen, just because companies don't need to go public.
It will never be as euphoric as 2019 to 21. Just like it didn't become as euphoric as 19 to 1 since 98 to 01. It was too easy to go public. Immature companies went public.
It was messy.
It was messy and not good for the industry, not good for those companies. The IPO market will come back, but the minimum scale to be public is dramatically higher. And that is good for the industry, and that is good for the companies.
What does that mean? In other words, you mean like profitability metrics? Like that's
predictability, profitability, and a minimum market cap. In our view, the idea you can be a successful publicly traded company with a market cap of under $1 billion, it's not consistent with the world today. I think in our mind, you have to be $3, $4, $5 billion market cap with a free float north of $1 billion to have equity research coverage, to have institutional support, and to have the maturity to be able to communicate with the market in a way that's understandable and have enough liquidities that small moves in supply and demand of stock don't plummet or cause a massive hike as the one we were seeing and you were just commenting with the other company.
Martín, in the growth equity space at General Atlantic, are the exits in your world typically IPOs, or could they be other types of exits sold to another private equity firm, for example?
That's a great question. Thank you, Tim. If you take the 20-year view, 50% of the time we're exiting to a strategic or to another private equity, typically in a controlled transaction.
That's a lot.
50% is in the public markets.
Okay.
That's the average, and the average, as you know, is always deceiving. In 2019 to 21, it was 80% through the public markets because the markets were very welcoming and, as you said, messy and disorganized, but easy to find liquidity.
Very receptive.
Over the last 3 years, 80% is to strategics. On average, it looks like 50%, but the day-to-day fluctuates a lot.
Wow, that's a lot. I am curious, though, you said about the growth, your portfolio companies are seeing growth of 30 to 40 to 50%. I'm assuming that's year over year?
Year over year.
Year over year. Is that continuing? I'm just curious if there are any kind of markdowns that you're going to have to take because of kind of a reset when it comes to a higher rate environment.
There was a big reset in valuations. So the multiples we're being asked to pay today relative to what we were asked to pay in 2021, 60% below.
Okay.
We've reset to a new reality. Some would say it's overcompensated to the downside. The growth, the engines of growth, which we can talk about what's driving the growth in the portfolio, are undimmed and remain extremely strong. So when I say it was the worst of time, we were talking about the difficulties in going public. It is the best of times because the engine of growth, which is driven primarily by technology, is alive and well, and we're not seeing, with rare exceptions, any degradation in the growth of the companies.
Martín, when you talk technology, Tim and I talk about this all the time when we have a guest. I mean, technology is a big bucket. What's the technology where you are seeing that 30, 40, 50% growth that you guys are investing in?
If you take a step back, we believe we as a growth equity are benefiting from 3 revolutions. And it's indirectly answering your question. The first revolution is digital transition. More industries are doing more of their interactions with their customers and with their suppliers digitally. It's a trend that's 25 years in the making, now accelerated by AI, truly transformative. That's one driver of growth, and it has to do with the transition to a digital world.
Right.
The second revolution is healthcare innovation. The healthcare system today is not functioning correctly. In the US, for example, and we're global, the US is about 45% of what we do. In the US, healthcare spend has gone from 12% of GDP to 24% of the GDP before the baby boomers get into the really expensive phase of their life from a healthcare perspective. The system, which pays for services, is doing too much service and not enough health. It's only with technology can we get better service at the right place at the right price and improve health spend while reducing costs. Technology has a role to do. At the same time, we believe we're in the golden age of biology. There's a whole revolution happening with biotech. 45% of the disease burden of the world has a biologic solution in clinical trials somewhere in the world. And we're in the very early innings of that revolution, which has got 20 years left.
So it's not necessarily tapping into DNA, but you're talking about companies that already have some kind of solution that they're on the early stages.
On the early stages.
Because we've done a whole story on 23andMe who believe that, we're hoping to kind of, monetize kind of the mapping of the genome, but it just kind of hasn't worked.
This is about therapeutics to address Alzheimer's and cancer and other diseases and Parkinson that probably over the next 20 years we'll figure it out. And that's super exciting. That rate of innovation, now again, turbocharged by AI, is going to happen faster. And for people my age, it's great news. Couldn't come at a better time.
You're thinking the longevity.
Sorry. Hey, Martín, what's the common thread that sort of unifies your investments? Like if there's one characterization of a company that you could make that says, okay, well, every one of the companies that I've invested in and for growth equity has this one thing.
Entrepreneurial, innovative, global.
Yeah.
So size doesn't matter.
So we start really small. We'll write checks of $25-50 million of a company that could be growing very fast from a small base. But we try to find people who are having a part in one of these revolutions with a mousetrap that's interesting. It's generating economic value. It's a mousetrap that is defensible, meaning it won't be eroded over time, and it has a team that is ready for the mission.
What's your success rate?
So we lose money 3% of the time. To some extent, 97% of the time we get at least our capital back. 10% of the time we have a blockbuster outcome. And these 10% of deals generate about half of our return.
Wow.
And that's been true for decades. And if I were to reflect what are the common characteristics of those 10%, they share a couple of characteristics. They're going after very large markets.
Just got about 15 seconds. Go ahead.
Okay, large markets, great business model, and good team.
Sorry, I didn't want to.
That was good. You're hired.
I got it.
Yeah, you can work with us. I didn't want to have you cut off. Martín, thank you so much. Look forward to checking in with you again. Martín Escobari, he is co-president and head of global growth equity over at the private equity firm General Electric, joining us here in General Atlantic.
Wow.
GE. Sorry, that was from the past.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.